Hello and welcome. You're watching Business Today Television. I am Sakshi Batra and this is a very special edition. This is the show where we're not going to be talking about any live prices or stock ideas that you should be spotting on a minute-to-minute basis. But this is going to be an extremely important conversation that you as a long-term investor should be watching out for as well. Looking at the markets, 4 months and on kind of a consolidation that's played out. In fact, a losing streak on the Nifty that's not been seen for the last 20 years. This fact itself is enough to dampen the sentiments of retail investors who've just started investing in the last 4 to 5 odd years. Because they are not seeing the usual trend of the markets that panned out in 2024, a resilience that the Indian stock markets displayed every time there was kind of a mini crash or a correction. So what has really changed in the markets? Is the sentiment really going to be even worse from here on? Are we going to be getting into a deeper correction zone? If that happens, what is it that happens to your portfolios, and should you be worried at all or not at all? If those are the questions that are on your mind, then you are right here at the right show. We are going to be welcoming a very special guest on the show. Mr. Rajat Sharma is with us here in the studio, CEO of Sana Securities. Warm welcome, Rajat, and thank you so much for taking the time out. I was discussing with you offline that how important is it to convey the right message at this point in time when the markets are extremely volatile. We do not know where the next uncertainty will actually hit the markets or the sentiments and which pocket in the markets as well. Of course, portfolios are bleeding red at this point in time. People are making a lot of losses. But tell us, how should one really look at those losses at this point in time? If one is a long-term horizon kind of an investor, should they be worried at all with this, reds that they're seeing in their portfolio?
Yeah, you see, look, first of all, I think markets, it's always an uncertain time in the market. So to say that markets are right now uncertain and how should you look at markets from this point onwards is like, how do you look at markets from any point onwards? Even in the most bullish scenario, markets are uncertain, and even when markets are most bearish and delivering negative returns, they could still deliver the worst possible results after that. So there's no such thing as certainty in the markets. Deeply undervalued markets can also keep falling in. Extremely, as we saw, extremely expensive and good markets can keep getting more and more expensive.
Yes.
So how should you deal with this? How should you plan your portfolio? Unfortunately, the answer to this lies in planning your portfolio before market moves higher or lower, which means that you should have a state of mind of a long-term investor to stay the course. So I'll explain what I mean. I was just talking to a client of mine recently who just is a new client, and I told him, whenever you start your SIP plans, let's say you're investing 50,000 or 1 lakh rupees a month in SIPs, at some point in the next 2-3 years after you start, you're not likely to see a negative portfolio value. In 100% cases, you'll see your portfolio in the negative. Okay. And the reason is, nobody talks about it. The reason is, if you're investing 1 lakh rupees a month and you keep doing that for 24 months, yes, and markets keep growing 10 to 12% right, year on year or 12% year on year, which is something like 1% every month. And in month number 25th and 26th, they fall 10%, which is what happens, every 2-3 years they fall 10%. Your overall portfolio, in 24 months, you would invested 24 lakhs. Correct. At the end of 24th month or 25th month, when it falls 10%, it would be less than 24 lakhs, despite the 10-12% every year. Because, you're accumulating slowly, and when it becomes a larger lump sum money, it just falls 10%. Wow. So the way to do this is, just when you're starting, put a portfolio value, write 20% less than that value. Are you comfortable to see that kind of loss? Because in markets, you will see that loss at some point. So, if today when markets are falling, you can look at your portfolio and say, okay, I was prepared for this, this had to happen, then you will certainly make money over a period of time. Other than that, if you're going to keep looking at it day to day, how do you make money? You may get lucky one day, you may get unlucky the other. It's a gambler's chance. Absolutely. So right now when markets are falling is actually a good time to invest and hold on to your portfolio than selling it and getting panicked. The worst time to sell is when markets are falling. The best time to sell is when markets are rising.
Yeah, but the opposite is actually happening at this point in time.
That's fear.
Yeah.
That's what fear does. And one of the problems is that there is so much noise these days around what to do with your portfolio. and human minds are anchored, so they end up searching for over Google or searching or looking for things which suits their mind. So if they're fearful, they would look at what to do in these markets when it's falling. So naturally they'll see results that markets could fall a lot more. American markets are likely to fall a lot more, and Federal Reserve is about to do something. Donald Trump is going to increase tariffs. So Google or any of these social media apps, they just show up what you want to hear, what you want to see. So
very important point that you make. A lot of noise across us. I mean, we are in the social media age. You have from WhatsApp to YouTube, you have every sort of medium throwing in either some kind of stock advice or some kind of an opinion about the market. But the question is, who do you listen to? Who do you not listen to? How do you know what is the right advice from all of that noise, Rajat, truly?
Yeah, no, this is difficult to answer. What I can say is that you have to decide who you should listen to and not listen to everyone else on a day-to-day basis, because there is so much noise. If I go back 20 years or so when I started being a financial advisor, I remember there was a shortage of information. If you had to study a company, you had to take out their balance sheet manually on paper or on a computer, do the ratios of return on equity, price to earnings. Then came a time when you had like a lot of these online websites and apps like Screener, which are great by the way, which show you everything. It's already done. You can see all the ratios. You can understand the company. Now we are at a time when there are people on social media and YouTube who are analyzing these results, giving their own views. A lot of them doing it just to get eyeballs. I can safely say 80 to 90% are wrong, or they don't care about whether they're wrong or right. They're just doing this to get eyeballs, to get more and more people to, recently, just to give you an example, recently I saw
clickbaits or views.
Yeah, recently I saw like something showed up on my Instagram account. I may be seeing something finance related. It showed up which said markets are likely to fall for the next 1 or 2 years. So you should stop your SIPs and invest elsewhere for those 2 years. Now, to be honest, even if I agree markets are likely to fall for the next 2 years, you should double or triple your SIPs and sell your lump sum, if at all, sell your lump sum, or move the money that you accumulated in equities, move that into something safer. And you should ideally be increasing your SIP investments, which you do on a monthly basis. Because if markets are going to fall for 2 years, double your SIPs, not stop them.
Wow, that's a wonderful takeaway. Yeah.
It's really strange. Like you're living in a world where everyone is saying and a lot of this is being said to make things exciting, because when you're exciting, when you say something out of the box, then people listen to you a lot more. But investments, unfortunately, are boring. You're not supposed to make investments exciting. The more exciting you make it, the more you're likely to lose. If you can do nothing and sit still and do nothing with your portfolio once the initial job is done right, of buying the right stocks, you will make a lot of money going forward.
So markets are boring, investments are boring. Take it that way and probably you'll end up making more money. Double or triple your SIPs at a time when the markets are falling. That's when you will actually make more money, rather than cutting or holding back your SIPs at the time when the markets are falling, because SIPs do not function in a staccato function. In case there is a period of downfall in the markets, put in more money as your SIPs, so that when the markets shoot up again after a few years, you have actually averaged down a lot of your SIPs in that lower money. So that's an amazing tip as well.
Actually, I could give you a perfect visual that people can have in their mind. So markets always move in. Think of it like circles placed diagonally on top of each other. So there's a circle, and then there's a circle, and then there's a circle. So each circle is a market cycle. So you start investing here, it'll fall, go up, and then you'll go on to the next circle. And then each cycle takes your portfolio value higher. But at some point, you'll do the round. So at some point, you will make losses, unless you're a trader, which I am not. I'm an investor. I invest for a longer term. So portfolio losses will happen. You should never commit money to the market which you need back in 1, 2, 3 years also. You should invest for a while.
Yeah. So on that point itself, I wanted to actually ask you, does it make sense for long-term investors to really think about, oh, I got into a wrong stock, oh, I invested at the wrong price, something went wrong and now my portfolio is bleeding because of those stocks, so I should probably knowing when to cut my losses, does that apply to a long-term investor too?
Yeah, on a lighter note, I think you should do that. You should do that calculation before investing. So if you've already invested and then you're thinking, have I got into a wrong stock? Then there's
Yes.
something wrong there.
Yes.
But if you've got into the right stock, then you should give at least 6 to 8 quarters for the stock to perform as per your expectation. Again, it depends on the the goal behind buying a stock. If you're looking to build a core portfolio, which is your main portfolio versus a satellite portfolio
Correct.
where you're buying something thematic and hoping to see how it goes for the next 3-4 years if plans. So let me do it this way. If you're looking to buy large caps, mid caps, small caps, which have a different risk profile, like if you're looking to buy something which is a large cap, it's super simple. Like look for companies which have done a very good rate of sales growth. Let's say a company which is growing its sales by 15 to 20%. Infosys, perfect example, growing its sales by 15% year on year.
Sure.
They have years where they grow their sales 20-24%, but there are years when they've grown their sales by 6-7%. But on any 10-year, 20-year, 30-year rolling basis, their sales would have grown 15%. Good rate of growth, and then you have to look for a time when their price to earnings multiple, the stock is not very expensive. It's available around 10 to 20% cheaper than their historic 10-year price earnings multiple. You buy it and then you wait.
Yeah.
If you're looking for something in the small cap and mid cap space, the way you look at those stocks would be different. You're looking to buy something which has a smaller market capitalization in an industry which is likely to grow a lot more. They don't have a past great track record of growing sales, but they're in a very exciting new area, new product where the market can exponentially grow and their earnings will grow a lot.
Correct.
So there are different ways to look at it, but when you should get out of that stock is obviously when you feel that it's been 4, 5, 6, 7 quarters, 8 quarters, nothing seems to be happening. When I look at their balance sheet, when I read their management discussion and analysis, which not many people do these days, they're not saying the same things that they were saying 2 years, 3 years before.
Okay.
If you start noticing these kind of things, that's the time when you should either reduce or completely get out of a stock. And keep in mind that nobody will get 100% of the stocks 100% right all the time. You will have those losers in your portfolio which you should know how to get out of. And
Have you had any instance of a losing stock and that you had a tough time deciding about that you should be exiting, but finally when you did, you thought that you had made the right decision?
Yes, lots of them. I've had stocks which did not work for me, which I sold. I've had stocks which worked very well for me, but here's the thing. The key takeaway that I can give you here is stocks that have done well for me, I've usually not sold, because I think if a stock starts doing well, then something's particularly right about that stock. What I see a lot of particularly retail do wrong is stocks that do really well, they end up selling those and they end up averaging out stocks that have not performed. That's like throwing good money after bad money.
Wow, okay.
Stocks that have done well, if a stock has done 20, 30, 40% year on year for the past 3-4 years, most likely chances are that's the case to buy more of it.
Buy more of it.
Not sell it and buy the stock that's not doing well. And if you do this calculation backwards and see all the stocks that you've been averaging and all the stocks you've been selling, you'll realize that this always works this way. Always, buy more of the stock that's doing well.
Even if it is going higher, you keep on averaging at the higher levels because it is working well for you. And
retail investors typically do it the other way around.
Opposite, absolutely, because they feel that the lower the price that they get, they will probably get to see their higher prices someday. It's always the psychology that I want to make money from that losing stock only, so I don't want to get out and probably buy that bullet and look at some other stock.
I think it's typically, I see it all the time. It's typically I bought it at that price, so I'm not going to sell it until it reaches that price again.
Yes.
Even if I were to convince you that you sell this and buy something else, that would reach that price faster. So you'll recover your 20% faster in that stock versus waiting 7 years in this stock. But it's human nature, It's like the perfect example I give is a lot of people say I've spent so much time building this relationship, I don't want to have a breakup because it's too much effort has gone into this. I would say break up and move on.
Oh, break up with your losing stocks and move on. Go after your winning stocks is the mantra that you should probably be having. Okay, that's another very good one that you've mentioned. You did mention a few things that you should look at when it comes to selecting stocks. You did talk about consistency. You did talk about, a particular amount of, sales growth that, they're looking at, or a top line growth that they're looking at a consistent period of time. But then I want to understand from you, where do you spot disruption happening? Where do you see things changing? I will give you an example here. Maybe it's the right example or not, that you can help me understand. I will talk about Asian Paints. You talked about Infosys. Asian Paints, another big wealth creating story of the past 10, 20, 30 years. Consistently, it has gained profits quarter after quarter. Every year, it has posted profits. But last 1 year turned out to be a really bad one. Now, there is concern about competition rising. Now, for such a large market leader, probably it should not matter so much even if competition rises. But what exactly is going wrong with Asian Paints, and how should investors be really looking at an erstwhile wealth creator when the prices are falling, when the earnings are also falling, 23% down in last 1 year?
Okay, so I think you've asked two questions here, and these are two completely different areas. Stock exploration. So when I look at stocks from a top-down approach, which is what I do, disruption. So Asian Paints is not a disruptor. In fact, Asian Paints, the paint market is being disrupted.
Yes.
So when I talk about stocks that can disrupt, and those are typically in mid and small cap category stocks which can do very well going forward, I usually and typically do it based on refinement of my everyday observation and thinking. When I see something doing well in the market, when I see something, by market I mean bazaar, by market I mean like in markets when I go out and see. That's where I get a lot of my ideas from, and that's where I feel, yeah, this is a good stock, you should buy this should do very well exponentially over the years, and I buy a smaller quantity in it. Asian Paints, again, I'll give a disclosure, is I'm really positive on this. It may not do something for the next couple of quarters, but eventually it will bounce back in a big way, and I'll tell you why. So you see, Asian Paints is a perfect example of a company having a very strong economic moat, and right now it's suffering or struggling because I hear people talk about volumes declining. Volumes are not declining for a particular stock. Overall paint market volume has remained the same. What's happened, or maybe it's flattish, but what's happened is in paints there's a lot of new competition. Birla, Opus, and they are spending aggressively. They're growing. You see their shops and showrooms everywhere. Then JSW, Pidilite, then there was already existing player Akzo Nobel, Indigo Paints, Berger. So much competition has come in, and Asian Paints is right now doing nothing. Keep in mind that from 59% market share, they still have 50% market share in the paints industry, and the balance 50% is all the others put together. Now this stock for the first time in the last 2-3 years has delivered negative sales growth. I think the last 15-20 years that I've been looking at this stock, it's never had negative sales growth. This is the first time that that's happened. And right now it's available at valuations of 45, 48 or so, which I think, given that 3-4 years ago it was available at valuations of 100, 102, at which time everybody wanted to buy it. It was in every portfolio manager's portfolio. It's available at half the valuations. Nobody wants to buy it. But look, this is a perfect example of a well-established company which is not going anywhere but facing extreme environment externally because of new competition entering. Typically what happens is that what we've seen 8 out of 10 times in past, what happens is that they will keep fending off the competition for a few years, not burn a lot of money, let their competition burn a lot of money, and eventually they'll increase the margin that they pay to their distributors, and they'll again, because they have an established, they're a logistical marvel, they're everywhere, they'll just start paying higher and higher commissions to their distributors to sell their buckets of paints as you go buy them, because even right now Asian Paints' biggest market is not corporates, or it's still the retail which paints their own residential homes. So they will increase those margins and it will bounce back. So we've seen this before at one time with Colgate when Pepsodent came into the market, and Colgate had a 50% plus market share, and that's what they did. Eventually they increased their margins for the distribution network and they came back in. I am in no doubt that this is what will happen with Asian Paints. In fact, many such stocks, Hindustan Unilever, Asian Paints, a lot of these especially consumption driven stocks, they're also facing problems because of general consumption slowdown. So, when you see stocks like these well-established companies facing externally challenging times because of competition or otherwise, it's actually a great time to buy these. And
How would you look at a DMart versus Zomato or Swiggy, quick commerce taking over giants, retail giants?
see, personally, I think in India both will stay. I really like the business model of or what Zomato and all is doing. I've never liked it because of its valuations, and I think it's extremely stretched even right now. But the way they're expanding, it's a business which is here to stay.
Yeah.
With the kind of traffic you have on the streets, people would eventually end up paying slightly higher than they would by eating at the restaurant also, because you're not paying a little high, you're paying to get it at your home, the comfort of eating while watching your Netflix or TV.
Sure.
So it's a great business. It's here to stay. The margins will keep growing, but I'm really not comfortable in this expensive market to buy a stock where the valuations are so stretched.
Yes.
And now with their acquisition of Blinkit and stuff. So to answer your question, I think both models will stay. Which one would I bet more on? Would probably be the quick commerce, the digital online. That's where the world is moving. But I'll wait for it to correct substantially from here before I initiate any buying. And this is not just with Swiggy or Zomato versus DMart. You see this kind of competition, companies which are taking to digital mode of doing things. So everywhere this is one of the key things that I'm looking at. Are they selling digitally? Are they selling online? Even paints or anything.
Yeah.
Are they adapting to the changing world?
Correct.
So yes, my clear preference is that you buy something which is more digital.
Okay, fair point. Understood that point as to how to understand, companies, versus disruption that comes into the market. I also wanted to get a sense of, would you like to call out any sector that really screams caution at this point in time in the markets, where investors would rather burn their hands if they go in at this point in time? There is a lack of clarity or lack of performance at this point in time. Is there any sector like that?
I think there are many such sectors which I'm staying away from. I think PSU stocks have run up a lot, and right now there seems to be a sudden urge for people to, buy more of PSU stocks because they've fallen around 10, 15, 20% from their peak, not realizing that they had run up 300, 400%. I mean, some of the stocks had gone through, you have stocks which have never traded over price to earnings multiple of 4 or 5 or 6. Steel companies like Steel Authority of India and stuff.
Yes.
Power companies were a perfect example. Your SJVN and NHPC was like, within the next 3 years, everything would be run on solar and hydropower. That's not going to happen. From 24, 25 odd rupees, these stocks moved to 140, 150. The valuations were like through the roof. Even right now, the way, SJVN today is available at 90, 95. And I think it's even right now very, very stretched. Yeah. So I am very positive. So this is to go back to the point I was making. I'm very, very positive on this sector, but I'm not positive on the stocks listed in this sector. We need power. We need exploration companies to do well. But as if you're looking to invest in stock markets and make money, you don't buy something which is clearly screaming caution. So I think PSUs, particularly in power generation, railway stocks, defense stocks. Yeah. The other sector I feel is a little stretched right now. Again, a trend which people are talking about should do well is real estate. Look at the way these stocks have run up, whether it's DLF or Prestige or any of these stocks, Macrotech, they've all run up the way they've run. I think real estate should do very well. Real estate stocks, listed space, may not, because they've already run up far ahead of their valuation. And at the same time, you have banking stocks, which are available at possibly their decadal low valuations. I've not seen a lot of these private sector banks trading at the valuations at which they're trading since I started 20 years ago. Private banking, consumption, these are sectors to focus on.
Private banking, consumption, these are the sectors to focus on. You did talk about Donald Trump, and I wanted to ask you this as well. A lot of retail investors are right now worried about why are FPIs pulling out the money the way they are. I mean, in January alone so far, we are just into the second month. $10 billion has already been pulled out. 2024 year again was only on the basis of primary market investments, still a net positive, but largely in the secondary markets there was an exodus again. And there is a lot of fear about whether Indian markets will stand a chance. We were already one of the worst performing in 2024, but how do we going forward perform? Globally, where do we stand?
No, so I think there's two things here. Why a lot of this money is being pulled out of
Yeah.
India is, frankly, you hear market voices. Everybody has their own opinion. Personally, I think what's happening now is just a spiral effect. Now, what I mean by that is that when Trump came to power, there's plans about a lot of tariffs that he's going to impose. So there's fear that companies across the world, now there's new talk about 25% tariff on steel and all of that. So I think companies around the world will have lower profitability because tariffs will go up. All that has played out. Everyone knows that. I doubt if this tariffs is permanent or is it going to stay or not. But right now what's happening is this whole spiral effect of currency falling, like Indian
Yes.
rupee depreciating constantly, and a lot of money is being pulled out. It's like rupee is falling, so you should withdraw money from from that country, and if you withdraw money from that country, rupee will keep falling. So but I think FIs will come back. A lot of this money will come back because eventually capital goes to where it finds growth, and India will remain a very fast growing economy for the next 2-3 decades. I'm pretty sure about that. How long will this go on for? Personally, I think this would be the end. We've seen a lot of this selling happen. It typically happens that when a global leader, especially an American leader, comes and makes so many announcements, and it looks like American markets are going to deliver very good and they're super safe. So money moves towards safer asset classes and stuff. But right now, when I compare Indian markets to American markets, given the growth that Indian markets offer, I find investing in India more favorable. And I'll give you a disclosure. About a year and a half back, I had constantly made a point that you should diversify your portfolio, look at investing in US stocks, and we did a lot of that. Look at investing in Chinese stocks I was doing last year. And right now, as I look at things, I think Indian markets are now better priced and available at better valuations vis-a-vis American markets, both from the point of view of an overall growth and currency.
Okay. But for a retail investor, how important are the external shocks truly? I mean, everybody focusing on what tomorrow Donald Trump will say on tariffs, how will the policies change and the impact that will come into India, either directly or indirectly on some of the sectors or the entire market. For somebody who has a 5-year, 10-year horizon or a 20-year horizon, does it really matter what will happen at this point in time? Should one continue to stick with their long-term portfolio, even if the stocks immediately as a knee-jerk reaction fall do a lot?
So, short answer, I don't think it's important at all. I think the not listening to these things and not focusing on these things is far more important. What Donald Trump says today, or what Federal Reserve says about inflation as they were about 6 months back, there was a lot of talk around that, or what happens in China, or what happens with oil prices. The lesser you hear these things out, you should buy a good stock of a company which is in business, which will remain in business at a price which is sort of below the price at which it should be. Buy it and hold on to it for a few years, and all these things would even out as they have for many decades, almost 5, 6, 7, 8 decades, for which you have trackable or traceable history. And remember, when you talk about if you take the present case in point, what Donald Trump is saying, or what he's talking about, what's the best for the United States.
Yes.
I believe in our government. I think our Prime Minister will go there, and he's always done a fantastic job when it comes to business, and I think he will do the same this time. Americans have it in their interest to have India as their biggest market, so there will be some give and take, but eventually things will pan out. So it's not like he's going to say something about tariffs and Indian companies will stop operating, or businesses will shut down.
Yeah.
These things keep happening, but it takes about 2 months, 3 months, 6 months for these shocks to, Donald Trump will come and go, Indian prime ministers will come and go. These businesses that I'm talking about will be there even
Very
after
important.
all of us.
Very important.
So, yeah, you should invest at businesses when they're available at good prices and offer great growth.
Absolutely. And you did say that India probably is now priced well and FPIs will return to India too. But are you then ruling out this entire fear-based questions on are we going to enter into a bear market? I mean, like 4-5 years of consistently in a bull market. Do you think there are any chances of a bear market condition developing, or are we going to come out very soon of this long drawn consolidation?
See, I can answer what I think or what I feel, but I'll just first go back to how we started this interview. This is your first question was, how should you stay the course?
Yes.
And if my answer to that was stay the course, then I'm not going to say do anything differently because we're going to enter into a bear market. So, but again, this may be different as a strategy. How you look at markets may be different for somebody who is, to my mind, the worst way of investing, who's all in, all out. I hear a lot of people, is it a good time? Should you invest right now or should you not? I'm always invested in the market. I'm always not invested in the market. So I have a portion of my portfolio which is not in the market.
Okay.
The percentages keep changing.
Okay.
So if I fear that, we are going to enter into a slowdown phase, markets may not do much for the next few months, which is not how I feel right now. I'll come to that in the second part.
Okay.
If I feel that way, I just increase my allocation to fixed income, decrease my allocation to equity, or I shift my portfolio of equities into sectors and stocks which I believe are right now fairly undervalued. And that's the approach I'm taking right now, because right now I think it's fairly skewed. You have certain sectors which are very, very expensive. You look at Nifty 50 stocks, 50 of those are trading above their 10-year valuations, 50% of those. And the balance 50%, about 25 stocks are undervalued, and some of them are fairly undervalued compared to where they were. So, it's about portfolio rejig. And keep in mind, it also depends, I have to invest money on a monthly basis, and I have fresh capital coming in on a monthly basis.
Yes.
So I have the liberty to invest, if I have a portfolio of X amount and 2% of that value keeps getting added month on month, then I have to invest it in such a way that I don't unevenly end up holding debt or hold too little equity, because we've seen in past, who would have thought after COVID markets would have doubled or tripled?
Yes.
And we've seen in past and we'll see in future that it would be very, very unpredictable, more so because now in the last 10-15 years, printing money and getting out of trouble seems to be the new norm, which was not the case 20 years ago when I started.
Yes.
So who knows, the next big swan event where it seems like things are coming to an end may actually be fairly positive, because interest rates around the world would dramatically be cut, and there's a lot of glut of money which comes in the market, and people end up buying stocks with that.
Absolutely. You did point out one more thing, that portfolio rejig at the right time probably will be important for you to see at every cycle in the market, along with your own financial advisors. I wanted to ask this one basic question, and that is, how many stocks should a retail investor really be invested in? So, if for instance you're saying that yes, a part of our portfolio money is still lying, as for me to look at opportunities and then therefore invest, and be fully invested at the same time in some particular stock. So, how does one really decide for themselves, how many stocks should one eventually be invested in?
Well, typically I suggest, your core portfolio, something which you want to hold for 8-10 years or long, should have around 10 to 12 stocks, is my view. There's a lot of people who I really respect, who are big believers in diversification, who believe that, you should have around 40, 50, 60 stocks, like a mutual fund. But for me, 12, maybe 15 stocks is what you should have in your core portfolio.
Wow.
Yes, it's just worked for me. It's 8 to 10%.
12 to 15 stocks only.
It all evens out. If there is a stock in which you have 8 to 10% of your concentration, then that does terribly bad, goes down.
Sure.
There would be another stock which does fantastically well, and it's all the same as it would be when you hold 40, 50 stocks. Keep in mind, what I'm saying is, besides this core portfolio, I do invest in some themes, very small amounts, 1% or 2% of my portfolio in very small, young, upcoming companies, where I think, I'm going to invest it and see if this business takes off. If it doesn't, then I'm going to sell it at a loss. So that's a very separate thing. I'm talking about a core portfolio which I'm not going to sell based on, as you said, what Donald Trump says or what happens.
So this will entail all three large, mid and small companies?
Yes. Typically, 15 stocks would cover sectors, segments, capitalizations, everything. So it's a very focused portfolio. It is what works for me. I have gone above that. Right now, it's about 15, 16 stocks that I'm holding, essentially, both for myself and in portfolios of a lot of my clients.
Wow, that's interesting as well. When you talk about diversification, that's the last point that I'm going to come to. How important is looking at a gold or a silver, which is also at record high levels already in, I was just reading up before we started the interview, already in the new year in 2025, gold has broken 10 records already. Today, as we speak, international gold has crossed $2,900 an ounce, and domestically also we are looking at an impact of the rupee. So how are you looking at diversification beyond equities, for instance?
So look, I'm a big believer in diversification across asset classes. And around 10-15 years ago, my view was gold is the most useless asset class because it just lies in a cupboard and keeps growing in value. And you know, the older self of me tells my younger self that that was a completely flawed and wrong view. Because for good or bad, I think the way this world is moving towards a heightened currency war environment, you will see that there is only one historical uniting currency which countries would go to. Look at the way China is buying gold.
Yes, yes.
And they're even discovering gold. I think more and more this problem with the US dollar and replacing it with a BRICS currency or settling trades with each other, more and more of this will happen. Gold will keep doing better. And if your view is that markets are overvalued, then you should have gold as a hedge in your portfolio, at least 10 to 15%. So I think you should diversify with gold. Also, besides gold, I think one thing that you should do in this market is have a higher allocation to fixed income investments. These days, there are individual corporate bonds which deliver something like 8 to 9% with favorable taxation. So I think you should invest in those bonds, keep a good portfolio which is growing at a consistent rate. A lot of times people say, you know, when you're sitting on cash, you're not making anything. No, when you're sitting on cash, you're still making 9%. So keep that substantial portion of your portfolio there, so that in case there is a correction in the market, you can move that money over there. So I believe in diversification, as I said, not within stocks as an asset class. 15, 16 stocks, enough. 12 to 16 stocks, enough. You've diversified enough in terms of but within asset classes, I'm a big believer in diversifying across asset classes.
Fantastic. Well, Rajat, it's been an absolute pleasure to have you on this special conversation, and I'm sure this has really enlightened a lot of our viewers into the right fashion of understanding how markets will function cycle after cycle in the long term if you keep a long-term horizon. And of course, this also has enlightened me that even if your portfolio is as small as 12 to 15 stocks, you're likely to make almost similar amount of returns if you're in the right stocks as well. So you don't need to really look at an AUM of a lot of money spread across 50-60 stocks just like a fund does.
So
but in fact,
I'll actually just to add a point.
Sure.
If you want to take a case in point and to understand this, you know, there's a category of mutual funds which is focused funds, which hold very few stocks. Compare the returns of those funds with a diversified portfolio of 60. It would pretty much be the same.
That's wonderful.
So, yeah.
That's a wonderful take, Rajat. Thank you so much. Appreciate your time truly on Business Today Television. And viewers, we are going to be getting such insightful conversations many times over. So you can come back, have a relaxed, understanding of how our top market experts who have decades of experience really looking at the current scenario, cut the noise and really look at what really will help you make a lot of money in the right fashion in the markets. I hope this has really helped you out. Do write in the comments below as to how you found this interaction, and in case you would want to see more of it, do also send us your comments on that. Many thanks for being with us on this special. That Donald Trump is likely to announce new steel and aluminium tariffs today, and which could have importers to pay 25% on top of the existing steel and aluminium tariffs already. What does it mean for